Dr. Ian Lesser, and Senior Fellow and Head of the Geopolitics team at the German Marshall Fund, Ms. Christine Berzinia.
Good morning, and welcome back to the second day of the German Marshall Fund's Brussels Forum. We are happy to have you here to look more at the challenges. Yesterday was day one, and we were looking at what is important in the transatlantic community today. The war in Ukraine, Russia's invasion, what to do about it, was front and center, and other aspects that are related. What do we do about the energy crisis? How do we solve the situations we put ourselves in? And we're looking at this from a perspective of a call to action. We're not just here to gripe. We're here to be motivated, to take the next steps forward, and to feel as though we are the agents of courage. We are the agents of change, very much as the Marshall Plan was an agent of change here in Europe.
Christine, thanks very much. And so we're going to shift gears slightly, actually quite a bit this morning, and we're going to start talking about the global economy, where there are no shortage of challenges, as you know, whether it's inflation or it's global supply chain disruptions or labor dislocations, both short-term, immediate challenges that we face and long-term perspectives. And we have a wonderful group to discuss that with us today. But to moderate that conversation, I'm really delighted to introduce my colleague, Jacob Kierkegaard, who is here with us in Brussels as a senior fellow, GMF, and the Peterson Institute. Jacob.
Thank you.
Thank you.
Thank you very much. Well, yes, it's once again, what can I say? It's the economy, stupid, this morning. And we're going to talk a little bit about the global economy. I think it's fair to say we've got interstate war, we've got inflation, and that's at least two of the four macroeconomic horsemen, if you like. But it's wonderful we have a perfect panel with us to do it today. So I would like to introduce Maria de Mertzes and John B. Emerson. Maria is the Deputy Director of Bruegel, which is, I think it's fair to say, the best-known economic think tank in Brussels. She also has a background in central banking. The Commission, central banking will be useful for this conversation, and also has academic credentials from Harvard and the University of Strathclyde. John B. Emerson, former US Ambassador to Germany, Clinton White House, going back to the economy, board member of, I dare say, German Marshall Fund, among many other things, but first and foremost, of course, Vice Chair of the Capital Group International.
Hold your applause, please.
Yes. But basically, I think the basic question that most people have about the global economy is really quite simple. It's always about fear. So the question is, what do we fear most? Right now, global recession or inflation? Or do we have one and then the other? Is it inevitable? Where are we?
Inflation, for sure. You can see it in the numbers. You try and put fuel back in your car, and the first thing you see is that the bill has doubled. And actually, since September, it went up to doubling. Then it came back to sort of 75%. Then it went doubled again. So, yeah, inflation is definitely the biggest problem right now. And then there is, of course, the potential of a recession, but only a potential recession.
That is the optimistic spin.
Well, you know, if you look at the global economy today, we've got 5 things happening simultaneously. First of all, before February 24th, we already were dealing with inflation as a consequence of supply-demand imbalance coming out of COVID and some of the structural changes that were being made in supply chains by companies as they were moving from just-in time inventory management to just-in-case inventory management, and as governments were beginning to focus more on national security implications of supply chains. Think semiconductors, think pharmaceuticals. Secondly, we heard yesterday from the CEO of Exxon that energy markets were already tight, and we were seeing price increases there before February 24th. And then, of course, bam, Russian invasion, oil embargo, Russia weaponizing energy, and you know, we now heard many times yesterday in terms of potential shutting off of gas to Europe. Winter is coming. How many times did we hear that phrase yesterday? Thank you, Game of Thrones. And you know, friends of mine in Germany have been receiving indications from the gas companies that their gas bill will triple as of August 1st. Third, food security. There was already a global food security crisis before February 24th, and now we have Russia weaponizing grain and fertilizer. Fourth, central banks, which I know we're going to get into, their ability to deal with this is somewhat constrained. They're going to have to address inflation, and they're clearly prioritizing inflation over growth. And then finally, you have the economic model that has worked so well for Germany and worked so well for Europe, which is basically America defends us, Russia gives us cheap oil and gas, and we make great stuff that we sell to the Chinese. Well, that's broken. You know, Europe is going to have to start spending more on defense. They're going to, you know, obviously energy is costing a lot more. And we really got to start thinking, do we want the kind of dependency on China that we've had on Russia for a period of time? So, yes, inflation first, but it's a very, very complicated situation.
Okay, but if it's inflation first, then we got to talk about central banks. On the one hand, we've clearly, I think it's fair to say, we have a Federal Reserve that has clearly said, look, it's going to be inflation first. If it takes a recession, so be it. On the other hand, we've got a Bank of Japan that has just bought over 50%, is actually into the second half of all outstanding Japanese bonds. And then the big question, of course, here in Europe is, well, what about the European Central Bank? It has obviously been tiptoeing about its communication, but has signaled we're going to have a liftoff. I just saw they pushed back the announcement by 30 minutes yesterday by pushing but basically, Maria, what should they do? How do we deal with this specific, once again recurring, if you like, design problem in the euro area? We got inflation. They can't just do whatever they want on the stimulative side without having to worry about it. But spreads, what are we going to do about it?
Okay, so there's multiple questions in there. I think it's the first one I'll say is that the story of inflation in the euro area is slightly different to the one in the US. I think there is a delay in the inflation, both in the speed with which prices have gone up, but also the levels at which prices have gone up. And actually, when we talk about inflation in the euro area, we're really not really talking about one inflation rate. There's different stories in Europe, and there isn't just the one inflation rate. If you look at France, you have inflation of about 5% in annual terms. If you look at Latvia, Lithuania, you've got a 15% inflation rate. So, you know, euro area inflation rate really isn't telling us the whole story here. I think that's important to reflect on the fact Europe isn't just the one thing. And actually, the correlation between Russian dependency on oil and inflation rates today is enormous. You really see where the inflation rates are really accelerating. That's where the energy dependency is seeing. Now, in terms of what to do, though, because I mean, the policy really is one for those participating in the euro area, and they have to do something about that. So they target the euro area numbers. So that's understandable, right? But they're smaller than the US. I think that's an important thing. And the drivers of inflation in the euro area have been, up till now, up to very recently, I should say, really energy. And there isn't very much the ECB can do about that. And that's why they've been holding back. However, now we are seeing what they're famously called the second round effects, where everybody's trying to pass on the costs to the next step in the line. And that, of course, the central banks can do something about. It's inevitable that they will have to do so. When you see inflation going up, at the rates that it is today, irrespective of where it's coming from, the ECB has to do something about it, and they will. Even though they will announce it 30 minutes late, they will do something about that. Now, that's not without problems in the euro area, as you said. As the interest rates go up, we're having a rather awkward situation where the rates at which countries can borrow will also increase. And what's interesting about that, they don't increase at the same speed. Those countries that tend to have poor fiscal positions will see their interest rates going up much faster than others that don't have quite so weak fiscal positions. And that's a problem. That means that those countries won't be able to borrow to finance their own expenditures quite at the same capacity as other countries are. And that's what we call financial fragmentation. This is a unique euro area problem. You don't see this anywhere else, and it has to do with the architecture. And the question is what to do about that. I'm sure that the ECB has worried about that a lot, because the last thing we want now is a financial crisis. We don't want to increase interest rates as a result of having to react to inflation and yet shut countries out from markets, from the ability to borrow. This is a real problem in Europe, and it has to do with the fact that we are an imperfect architecture. My sense is that the ECB is thinking, without having any inside information, I think the ECB is really thinking about how to tackle not only inflation to the extent that it can, but also deal with this financial fragmentation. And they will have to think of new tools that they will be able to use to try and tame the markets and actually convince them, listen, we're doing whatever we can to keep both inflation at levels which are manageable, but also allowing countries to have access to the markets.
Well, John, for this purpose, at least right here, you're the markets guy. And there's always stuff going up, stuff going down. I mean, if you look at some of the sort of long-term market-based inflation measures, like the five-year forwards, et cetera, they've actually been coming down in recent months. But if you were to point out some of the silver linings of all this disaster scenarios in the market, what would it be?
Well, first of all, I would remind all of you that the average bear market lasts 9.5 months. Okay, so if you have a long-term, think even 3 to 5 years financial plan, stick with it. Okay, and let the professionals sort of make the nuanced changes within that. But I think there's several. I'll point to 4 silver lining areas, and they're not just economic silver linings, but I think geopolitical silver linings. Okay, one, with regard to energy, the good news is, with all the bad news that we've heard, this dynamic is going to hasten the move towards renewables. But it will only work if government and the private sector both, well, if government helps to fund that move to the extent that it can and creates a regulatory structure or incentives for the private sector to do it as well. For instance, in the United States, we have a $90 billion loan program out of the Department of Energy that's focused on, it's almost like venture loans instead of investments, because the government can't make equity investments, focused on green technology. So that's point number one. Point number 2 is feed the world. You know, we have a real challenge, we in the West, with the global South. I mean, the attitude of the global South, which largely many of those nations voted not to condemn this Russian aggression. We have a challenge because many countries in the global South, their view about, you know, the West or Russia is a pox on both of your houses. You guys promised us vaccines, you didn't get them to us. You've had a history of imperialism, grabbing all of our natural resources, etc. With Feed the World, we have an opportunity to combat Putin's effort to convince the nations in the global South that the food crisis is the fault of sanctions as opposed to his weaponization of grains and fertilizer by moving forward and investing in crops that are sustainable, that are pest resistant, that are drought resistant, that are higher yield, and sort of stepping in to fill that breach. So that's another area of opportunity we have. A third area is on trade. Now, the politics of trade in our country is fraught. We heard Will Hurd was talking about that last night at the you know, the midterm discussion about how tough that is. I see Jennifer Hillman sitting here. I know Karen Kornbluth, others who are here who have had a long history in dealing with this. I was working on TTIP extensively as ambassador to Germany. We're not going to get a big trade agreement, but there are some easy wins. If you look at the ability to coordinate and come to convergence on standards, if you look at some of the sanctions that were imposed during, or I'm sorry, tariffs that were imposed during the Trump years that can be taken off that really aren't that effective from a geopolitical standpoint, but that can help us economically. That's another area that is a potential silver lining for us. So I think and then fundamentally, you know, as things are I was just going to say one other area is as we rethink supply chains, think about in the United States, Latin America, think about in Europe, Africa, and the kinds of investments that can be made to train people and investments in production facilities in those places. Those aren't going to help in the immediate short term, but I think they can kind of shape the global economy so that we come out of this with some real energy, so to speak, moving in the growth direction.
And then I guess I have one final sort of enigma that I would like you to also weigh in on, which is, yes, we've talked about, we've got war, we've got inflation that we haven't had for a long time, but the really big, for me at least, is China. Now, there's a lot of talk about systemic rivalry, and some might even argue that there are entities who likes that rivalry, etc. But the reality is, if you look at the Chinese economy, there are some real issues. Right? I mean, do we actually, after what they have been doing on COVID, zero COVID, do we trust the Communist Party to do the rational thing on economics? We know what Chinese demographic looks like in the long run, and it has implications quite likely for the housing market, real estate sector in China. But what if we actually are looking at a world in which the potential growth rate in China might only be 2%? What does that look like? Where is growth in the long run then going to come from, given that Europe, the United States, everywhere else is also aging? You get the easy ones.
You get the easy ones, yeah. Look, I mean, I think that what you described is accurate. I mean, there's no denying that. I mean, first of all, let me just start by the controversial argument, which is it such a bad thing if we slow down a little bit? Think about the environment, the challenge of the environment. Now, I'm not part of the degrowth
Club
the club. No, I'm not part of it, simply because it doesn't sell. But in any case, it's impossible to imagine one generation from one generation to the next actually going backwards. It just can't do that. But it's undeniable that we've got to do better, and actually preserving the environment is going to push us in a direction of, you know, how do we save things? I mean, just these insatiable expansion. And we will not be able to meet the environment targets, which are very ambitious in the EU by all stakeholders, and will require huge changes in our own lifestyle as well. We've got to do that for the environment. Now, on China, because I think that is an interesting question. Again, if I were to pick on differences between the way that the EU and the US sees China, I think the US is a lot more decided what it thinks about China. Whether we agree or don't agree, that's one thing. The EU doesn't really have a position on China. The systemic rivalry, as you said, which is a buzzword, it's often used in this part of the town, but it is one that isn't necessarily shared by everybody, and it has actually implications which go beyond just the buzziness of the word. Now, my sense about China is the bottom line is that we cannot not engage with China. That's a fact. The US and the EU is about 800 billion people. The China is 1.4. Well, just that, the scale of it implies that we cannot not engage with China. Now, how would you characterize what you call the West and China? I think there's a dividing line that is actually quite divisive. All dividing lines tend to be. But in my sense, I think it's important to try and find a model that works, at least as minimal engagement. The multilateral system is absolutely essential that we find a way to engage with China. The WTO, which is perhaps the biggest multilateral forum that we have in terms of engaging in trade, will have to be rewritten. And China, no doubt, is going to have to hold the pen a little bit because it is a big country and it contributes to it. Now, how do we do that? What is the common denominator on which we can all agree and actually continue open and trade that is welfare enhancing? I think that's really the big question to solve. And it's going to require, you know, negotiations on both sides. It cannot be that China fits a rule book that is written by others for a very different system, whether we agree or not. If you believe that the bottom line is we have to engage with China, well, we have to find ways of doing that. And preserving the environment. It's interesting about, and I come back to the environment because, I mean, I agree with you, John, that this is an opportunity now. It accelerates the decoupling of fossil fuels, but we are very far from meeting our objectives, and China has even postponed its targets from 2050 to 2060, understandably, given that it's coming from a very low level. But in any case, China needs to be on board or it's not happening.
You asked on China, you asked would they behave rationally in terms of how they handle the economy. And my answer to that is yes, they will behave rationally given their perspective on economic growth and what they need to do. And I think one of the things we need to understand is we've got to do a better job of putting ourselves in our adversaries' shoes as we think that through. I think a couple of questions with China. Number one, the administration, while clearly tough on China is one of the few things you can get bipartisan support on these days, tough on China, tough on Russia, and maybe a little bit of stuff on guns, thanks to Chris Murphy. But, you know, the reality is the administration shifted somewhat because it's not just tough on China. It's tough on China, but also, you know, it's competing with them where we need to, but cooperating and coordinating where we can, particularly on issues like climate change, like nuclear proliferation, and taking a hard look at some of the tariff and trade issues. I do think Europe needs to ask itself, though, and I flagged this earlier, does it make sense for, you know, two of the great companies in Germany, Mercedes and Volkswagen, to get 40% of their profits from China? I mean, the reality is right now China needs Europe. And China, particularly with the United States sort of moving away from China more, China needs Europe. It needs it from a commercial standpoint. It needs it from an economic standpoint. This actually, I think, complicates their relationship with Russia, at least during the Ukraine situation, because they don't want to get painted with a Putin pariah brush. But does Europe risk 5 years from now, 7 years from now, being so dependent on China economically that China will have its same grips on Europe that Russia does today from an energy standpoint? I think that's a major question that has to be addressed here.
Now, we have a little time. If there's somebody in the audience who have a question they were dying to ask, you may have to speak up quite a bit, although you can just give me the question and I will repeat.
Hello, good morning. This is Atara from Istanbul University. So I was wondering how actually I was wondering how the ever-growing crypto markets, cryptocurrencies, and DAOs fit in this picture. So, thank you.
They don't.
Not at all, really.
Well, no, I mean, okay, so it's a very important question. If I were to give a few messages, one is cryptocurrencies, in my view, will not replace the big currencies, the dollar, the euro. They are not the same thing. They are a private issued asset that goes up and it goes down. It goes very, I mean, that's, if you're interested, if you're a risky investor, please go ahead, invest in them. But if you are not a risky investor, stay away from them. But they will not be the means of exchange that we call currencies because they don't have the right properties to become currencies. So in my view, they're just another asset. They will be regulated. I'm convinced about that. Aspects of it will be regulated, primarily the exchanges, which is where they're being transacted. But other than that, it's up to your risk profile to go and invest in them. They will not be currencies, in my view.
I would say when you think of crypto, there are two ways to look at it. Number one, the underlying technology, the blockchain technology. That is important. That's significant. That is something worth investing in. Crypto, go to Vegas.
Next.
Thank you very much indeed. This is Pablo Zalba from Deloitte and from MEP. I would like to go back to the issue of financial fragmentation. Maria raised the issue about the new tools that ECB should arise at this respect, or to cope with financial fragmentation and spreads. And my question is, at what extent that new tool or those new tools should include conditionality or not?
Thank you, Pablo. Lovely to see you again. So I guess that question is at me.
Yes, that question is definitely for you.
Yeah, so look, we have a tool, it's called OMT, which exists, has never been used, but it's good to have because if we were to...
Before we get it, we have brief answers. So OMT and the whole roll-up might not be...
2 minutes.
Yeah. 2 minutes.
The new tools need to look like OMT. They will have to be looking at OMT, but they cannot have the same conditionality, or they won't be in real time. The instrument that we need right now is an instrument that can be decided at the same cycle as interest rates, so they need to be done every 2 weeks, in other words, and therefore cannot have the same degree of conditionality. Now, that is the $1 million question, how to solve that. I've written something on it. I ask you to read it and see what conditionality we'll have instead.
Succinct, perfect. Next question.
Thank you. Dania Khatib from Research Center for Cooperation and Peacebuilding, Beirut. I have more of a comment than a question. The Chinese look at themselves...
Make it a question.
Okay, so the Chinese look at themselves as the Middle Earth. So they look at themselves as the rightful hegemon in the South China Sea. So what's the plan for the West? I mean, they're not going to relinquish on their ambitions in the South China Sea. Thank you.
I think the plan is to make it clear that if they proceed in a way that is similar to what Russia has done, if they proceed in a way of aggression and a military attack, there will be a significant price for them to pay. And I would have to believe that as Xi Jinping is looking at the Western response to the current situation, he's recognizing there will be a significant economic price to be paid. He probably also is saying, well, I guess they don't want to engage in a military conflict with a nuclear power, so he's maybe less afraid about that. But I would also think that he's looking at the impotence in many respects of the vaunted Russian military and saying, wow, are we even ready for this here in China? We haven't been in a shooting war since Vietnam in the late 1970s, and maybe that's giving him pause to think as well. So, I mean, what we need to do, and this is what gets back so important to Russia and sanctions and all that, and keeping them in force, we need to show that crime does not pay. And I think that's what we have to do about that.
I think we maybe have time for one very, very, very quick question.
Very quick. I'm Megan Richards. I'm a senior visiting fellow at GMF. You talked about the importance of energy prices, and Maria, you mentioned the importance of driving innovation with high energy prices. But the G7 has just called for a cap on oil prices. It's not really going to help in terms of improving innovation. We have to help the poor people. But can you give us an idea of how this is going to solve inflation and still generate innovation?
Can you do it in 30 seconds?
Theoretically can work very well. In practice, I don't think so. You can either have price controls or you can have quantity controls. Price controls are very difficult to enforce, in my view, particularly in areas that it matters. Well, how are you going to enforce a price cap on the oil price that the Indians pay? We cannot do that. I mean, and it would be very difficult also to enforce it domestically, because it could be somebody else can actually outprice us, as it were, and that's not going to work in my view. The only thing that works is quantities. Stop buying oil and gas from Russia.
Well, and you also heard the CEO from Exxon say yesterday that from a long-term standpoint, what they've got to do is develop sources of energy that work in a low-cost environment as well. So this is where the industry knows that it has to head as well.
Well, thank you very much. I would like to thank the audience, all of you, for paying attention, and my two wonderful panelists, Maria de Mertes and John B. Emerson. And then it is my pleasure to hand over to the next moderator, who is Martina Stevis-Gridnev, the Brussels bureau chief, and many, many other things that I don't unfortunately have time to go into for the New York Times here in Brussels. Martina.